I'm about to tell you something that goes against everything you've been taught about money. Saving money in a traditional bank account is one of the worst financial decisions you can make. I know that sounds crazy. Your parents told you to save. Financial advisors tell you to save. Everyone tells you to save in a bank account. But here's the brutal truth they're not telling you. While your money sits in that savings account, it's actually losing value every single day. In this video, I'm going to show you exactly why saving in a bank account is quietly making you poorer and, more importantly, what you should do instead to actually grow your wealth. I'm Finn from Smart Money and Finance Guide, and by the end of this video, you'll understand the hidden tax on your savings and the smart alternatives that wealthy people use instead. Let's expose the truth about savings accounts. First, let's talk about what's actually happening to your money in a savings account. Most people think their money is safe and growing because they see the balance slowly increasing. But that's an illusion. Let me break down the math that banks don't want you to see. The average savings account in 2024 pays about 0.5% interest. Some pay even less. So if you have $10,000 in a savings account, you're earning about $50 per year. That's it. $4 per month, less than a cup of coffee per week. But here's where it gets worse. Inflation averages about 3% per year. That means the stuff you want to buy costs 3% more each year. So while your $10,000 earned $50 in interest, it lost $300 in purchasing power due to inflation. Net result? You're down $250 in real terms. Your money is shrinking, not growing. Let me show you the long-term impact. $10,000 sitting in a savings account for 20 years at 0.5% interest grows to about $11,000. Sounds okay, right? Wrong. After inflation, that $11,000 has the purchasing power of about $5,500 in today's dollars. You lost half your wealth by playing it safe. Now, before you empty your savings account completely, let me be clear. Savings accounts do have one legitimate purpose, and that's your emergency fund. You should keep 3 to 6 months of living expenses in a high-yield savings account. This is not for growing wealth. This is for emergencies, job loss, medical bills, car repairs. This money needs to be accessible immediately with zero risk. For this purpose, a savings account is perfect. But everything beyond your emergency fund should not be sitting in a savings account. That money should be working harder for you. Let me show you exactly what to do instead. Alternative number 1. High-yield savings accounts. If you insist on keeping money in a savings-type account, at least get a high-yield savings account instead of a traditional one. Online banks and credit unions offer high-yield savings accounts paying 4 to 5% interest. That's 8 to 10 times more than traditional banks. On $10,000, that's $400 to $500 per year instead of $50. Now, even at 5%, you're still barely keeping up with inflation, but it's dramatically better than traditional savings accounts, and it's still completely safe and accessible. This should be your absolute minimum. If you have money in a traditional savings account paying less than 4%, move it to a high-yield account today. Alternative number 2, Treasury I-bonds and Treasury bills. These are government-backed investments that are just as safe as savings accounts but pay significantly more. I-bonds are savings bonds that pay interest based on inflation. They're designed to protect your purchasing power. They've been paying around 5% recently. You can buy up to $10,000 per year directly from the Treasury Department website. The catch? You can't touch the money for 1 year. And if you withdraw before 5 years, you lose 3 months of interest. Treasury bills are short-term government securities. You can buy them for terms as short as 4 weeks or as long as 1 year. They're currently paying 4 to 5%. They're incredibly safe because they're backed by the U.S. government. And you can create a T-bill ladder where different bills mature at different times, giving you regular access to your money. Alternative number 3, low-cost index funds. Now we're getting to the real wealth builders. This is what you should be doing with money you won't need for at least 5 years. Index funds are collections of stocks that track entire markets. The S&P 500 Index Fund, for example, owns pieces of 500 of America's largest companies. When you invest in an index fund, you're betting on the entire economy growing over time. Here's the powerful part. The S&P 500 has averaged about 10% annual returns over the past 50 years. Some years it's up 30%, some years it's down 20%, but over time it grows consistently. Compare that 10% to the 0.5% in a savings account. That's a 20 times difference. Let me show you what this means in real numbers. $10,000 in a savings account for 20 years becomes about $11,000. That same $10,000 in an index fund averaging 10% becomes about $67,000. That's a $56,000 difference. That's the cost of playing it too safe. Now, I know what you're thinking, but Finn, isn't the market risky? Won't I lose my money? Great question. Let's talk about risk versus safety. Here's what people miss. There are two types of risk: short-term volatility risk and long-term purchasing power risk. Savings accounts eliminate short-term volatility. Your balance never goes down, but they guarantee long-term purchasing power loss through inflation. Index funds have short-term volatility. Your balance will fluctuate, but over long periods, they protect and grow your purchasing power. Every single market crash in history has been followed by recovery and new highs. If you can handle watching your balance temporarily drop without panicking and selling, the historical evidence shows you'll come out far ahead. The key is time. Don't invest money in index funds that you'll need within 5 years. But money you can leave invested for a decade or more, that should absolutely be in index funds, not savings accounts. Let me give you the smart money strategy that combines everything we've talked about. This is what I do with my own money and what I recommend for most people. Tier 1. Keep your emergency fund in a high-yield savings account. 3 to 6 months of expenses. This is your safety net, completely accessible, zero risk. Tier 2, money for short-term goals in the next 1 to 5 years goes in treasury bonds, CDs, or high-yield savings. Buying a house? Down payment fund? This tier protects that money while earning decent returns. Tier 3, everything else goes in low-cost index funds. Retirement savings, long-term wealth building, money you won't touch for at least 5 years. This is where your wealth actually grows. For most people, this might look like 15% in Tier 1, 20% in Tier 2, and 65% in Tier 3. The exact percentages depend on your situation, age, and goals, but the principle remains. Stop keeping everything in a savings account. Now let's talk about actually implementing this. Knowledge without action is just entertainment. Here's your step-by-step action plan. Step 1, calculate how much you need in your emergency fund. 3 to 6 months of essential expenses. Step 2, move that amount into a high-yield savings account. Research online banks offering 4 to 5%. Opening an account takes 10 minutes. Step 3, open a brokerage account for investing. Look for platforms with zero commissions and low-cost index funds. Step 4, set up automatic monthly transfers from your checking account to your investment account, even if it's just $100 per month. Automation is key. The money moves before you can spend it. For your investment index funds, keep it simple. A total stock market index fund or S&P 500 index fund is all most beginners need. As you get more comfortable, you can add international stocks and bonds, but start simple. Let me address the most common objections I hear. Objection 1, but I might need that money. Solution, that's what your emergency fund is for. Keep 3 to 6 months accessible in savings. Invest the rest. Objection 2, what if the market crashes right after I invest? Answer, you're investing for decades, not days. Short-term drops don't matter. Keep investing through crashes and you'll buy at discount prices. Objection 3, I'm not smart enough to invest. Reality, you don't need to be smart. You need to be consistent. Buying low-cost index funds and holding them long-term requires zero intelligence, just discipline. Objection 4, what if I pick the wrong investments? Solution, that's why we use index funds. You're not picking individual stocks. You're buying the entire market. The market might fluctuate, but it's grown consistently for over a century. Here's the part that should make you uncomfortable. Every month you wait to move money out of low-interest savings accounts, you're losing money, not in the future, right now. Let me show you the cost of waiting. If you invest $5,000 today in an index fund and add $200 monthly, in 30 years at 10% returns, you'll have about $480,000. But if you wait 5 years to start, you'll only have about $290,000. That 5-year delay cost you $190,000. The earlier years of compound growth are the most valuable. You can't get them back. Every month you delay, you're permanently reducing your final wealth. That's not meant to scare you, it's meant to motivate you to take action today. Let me share something that changed my perspective completely. Wealthy people don't keep large amounts of money in savings accounts. They know that cash sitting idle is cash losing value. They keep what they need for emergencies accessible, and they put everything else to work. This isn't about being reckless. It's about being strategic. It's about understanding that true safety comes from growing wealth, not from hiding it in an account that pays almost nothing while inflation eats away at it. The middle class saves. The wealthy invest. If you want to join the wealthy, you need to think like them. And that means getting your money out of savings accounts and into investments that actually grow. Here's your complete action plan. Stop saving everything in a traditional bank account. Keep your emergency fund in a high-yield savings account earning at least 4%. Put short-term money in treasury bonds or CDs. Invest long-term money in low-cost index funds. Automate the entire system so it runs without you thinking about it. This isn't complicated, it's simple, but simple doesn't mean easy. It requires you to overcome the fear of change and take action. Most people will watch this video, feel inspired for a moment, then go right back to letting their money rot in a savings account. Don't be most people. If you found this video valuable, subscribe to Smart Money and Finance Guide. We break down investing, wealth building, and financial freedom into simple, actionable strategies. Drop a comment below. How much money do you currently have sitting in a traditional savings account? What's stopping you from moving it? I read and respond to help you take the next step. Your wealth building journey doesn't start tomorrow, it starts right now. Stop saving, start investing. I'll see you in the next video.